And the great thing about the business lines of credit is that you can pre-qualify. It only takes 5 minutes and there's no impact to your credit score. Minimal documentation is needed, just 6 months of bank statements and a debt schedule, no tax returns or complex financial statements required. My credit isn't great. Should I still apply? Absolutely. They know you're more than just your credit score, and their team will work with you to find the right solution. What's more important than actually trying to get approved for funding is actually having a plan on what you're going to do with it. One of the best things that you could do is put that capital into a proven business model. This shows a calculator of your expected payment would be monthly payment would be for SBA 7A. Now, this is the traditional 7A. Let's say you're borrowing 350,000. Your payment is going to be about $4,722. This is a 10-year term, 10.5%. Again, this will be the payment. So what could you do with this capital for it to make sense? One thing that's really hot right now, and they're talking about this silver tsunami, where a lot of these baby boomers are retiring existing businesses. I'm not telling you to do this. I'm just giving you an example. This is exactly 350. This is a FedEx route. And this is a website called BizQuest. There's Buy, Biz, Sell, where you can look at businesses for sale. And you can use SBA financing to purchase these cash flowing businesses. So I wanted to give a clean example of 350. So if you borrow 350,000, you could use that to purchase a business for 350,000. Looking at just the financials right here, this $350,000 business is generating $596,000 with a EBITDA. So EBITDA is earnings before interest, taxes, depreciation, amortization. So it's basically your earnings, $184,000. The monthly debt payment would be $4722. And then if we multiply that by 12, your yearly debt service is about 56,000. Let's just round it up, say 57,000. So based off of the EBITDA right here, 184,000, this could support the debt payment. So you bought it for 350, it's earning 185,000 and it's costing you 57,000. So you have about $127,000 left with the debt service. This is an example of a business acquisition that will be able to support the debt service. Again, this is just an example. I'm not telling anyone to go out and do that, but I just wanted to share this funding resource with you. Smart Biz Bank. Not only do they offer SBA 7A, so SBA Express 50 to 150, so the sub 150. Then you have the traditional SBA, which goes to much higher limits. And you also have bank term loans and a business line of credit minimum of 50 up to $100,000. No tax returns required for the business line of credit. But let's talk about the sub 150. I think that product is probably one of the more appealing products because they're not looking at the traditional debt service coverage ratio requirements. So for those who don't know what debt service coverage ratio, DSCR, let's say the debt service is $1,000 a month, but the business is generating $1,200 a month. That means there's enough money left over after all expenses to cover the debt payments and usually leave a little bit of a cushion, right? With the sub 150 product, it's not even looking at the debt service. It's only looking at the top line revenue and taking a max loan amount of 40% of that. That in itself is a game changer. I know there's a lot of businesses, for example, who might have a high gross revenue, but because of deductions, because of depreciation, their net income might be very low. And with traditional banks, they won't qualify because they're not profitable on paper.